Hello, everyone. Thank you so much for joining us yet again for our Strategic Partner Education Moment series on our brand new YouTube channel, Maxwell Devonshire Realty Partner Webinars. Today, we are more than blessed to be joined by Jeremy Kwok of business name?
Principal-Centered Financial Services.
Perfect. So Jeremy today is going to be talking to us about the difference between personal and mortgage insurance and protect your family, not the bank. So Jeremy, thank you so much for joining us, and the floor is yours.
Perfect. Thank you very much, Alex. I will share my screen here so then we can follow along with some nice slides that I have prepared for you guys here. And let's get this up into presenter mode. And there we go. Well, first of all, Alex, I wanted to thank you and also Jillian the opportunity to have this presentation. I do have a lot of respect for realtors because you guys are what I essentially call, dream makers. Most people dream about having a bigger house, bigger home, and you guys make that reality come true. You're selling sunsets with $1 million listings. Hope some of you guys got that. But the thing is, once you hand over the keys, it doesn't have to end there, right? You can continue to add value to the relationship, and how you guys can do that for new homeowners is to really protect what essentially might be their biggest investment they'll ever make in their lifetime. And that is just to ask one simple question: are you getting mortgage insurance? And this is to start a conversation. It's to educate and also to add value to the relationship between you and the client. Not because it's the right thing to do, but it's also because you care for your clients, right? So that's what I'm here to talk to you guys today about. So then you guys have an idea and have some information that you guys can arm yourself with. So then the next time you have an interaction with the client, you can talk about these things. So now, a quick introduction to myself. I own a little firm called Principal-Centered Financial Services. And here's what we do. We do a few things, but essentially what our firm focuses on is more so educating and creating awareness, financial literacy for Canadians. And through that, we create bespoke plans, custom tailored plans to make them achieve their success. And there are a few areas that we do work in, and today we're going to be focused on the insurance plans itself. But we also talk about investments, retirement planning, tax planning, estate planning, cash flow management, all that lovely stuff. Now, we have a home team and we also have an away team. My home team is my family. So looking on the left here, we have a little gold digger, Mason. He's turning 2 in January. And then also here's my lovely wife, Anna, lovely husband sitting beside her, which is myself. And then also I have my daughter who just turned 4, and she loves making silly faces. Now, the thing that goes on behind the scenes is we have a team that I work with. I'm very proud of my team, and we've been working together for a number of years. So on the left, we have Sandy, she's our bookkeeper. And then we have Narissa, she's the office manager that holds everything together, essentially. The person standing beside me is my mentor. He retired this year. And then the young lady on the bottom there is Janice, very capable, very astute. And then also, lastly, we have Derek, our associate, who's working with us as well as an advisor. Now, I think what we also want to really get some clarification on is what is mortgage insurance, right? The thing is, I think most people are in this situation that you don't have all the money, all the funds that you can buy a home outright, unless you're trust fund kids. But most people will save a certain amount called, your down payment or equity, and then you'll have to borrow the rest from a bank or some lender in the form of a mortgage. And that mortgage is a loan that is backed by your home. And that's what we're protecting here, essentially. So in the event of a death, sickness, or disability, there's going to be money, there's going to be funds available to pay for that mortgage, so then we can keep our home that we're building memories in. So today we're essentially discussing what is the difference between getting your own individual coverage versus the lender's coverage and what they're providing? So just to kind of get some idea, some background knowledge that you guys need to understand is that lenders essentially buy insurance from insurance companies. So for example, PC Financial, CIBC, they buy insurance through Canada Life. ATB buys insurance through Manulife. So the thing is that when they buy bulk insurance, they are in the business to make money, right? So the thing is that they need to take that product, they strip it down, and then they resell it. And that's how they make money. But the thing is, what they strip out is essential. And you need to understand the things that you're covered in and the things that you're not. So now the thing is that when you go get a mortgage, they're going to ask you a few simple questions. And after you answer those questions, you automatically qualify for insurance, regardless of what your mortgage is, regardless of generally your health conditions are. So there could be some details, some nuances that they're not quite disclosing. Not that they're, malicious and evil institutions, it's just the way it's set up. So I want to break it down so then you guys have an idea of what is covered, what is not, and what the difference is, essentially. So we have a few things that we're going to be taking a look at. All right. Now, the first thing is that what am I covered for? How much? Well, if you were to get your own individual coverage, you can determine that amount. You can say, well, my mortgage is $500,000, so I'm going to get $500,000. But if you're like, well, there's still some other debts that I want to add on there, you can add on there as well too. Whereas if you get lender's coverage, well, the balance is going to be dictated by your outstanding balance of your mortgage. Not only that, your coverage and the premiums are going to be reduced. Basically, as you're paying down your mortgage, your coverage is reducing and your premiums stay the same. So if we kind of do the math there, is that your cost per coverage actually increases. Whereas if you get your own coverage, well, the coverage remains the same for the duration that you're getting, and the premiums are guaranteed. They don't change. So this is something that you can consider and think about, because at the end of the day, if you're getting lender's coverage, your cost per insurance is actually going up. The third item is, okay, well, who do you want the money to go to? Most of the time, if you're saying you would want your money to go to your family, right? And you want the money to go to the family directly, and they can determine what they want to do with the money. They can say, okay, well, we have some mortgage that we want to pay off. We want to go on a family vacation, or whatever that amount might be, or the reason might be, they can dictate the reason behind getting the insurance. Whereas if the lender's coverage, the beneficiary is going to be the lender, and that's it. You don't have any other choices. Now, here's a key one, is portability, right? Most of the time, you would get a 5-year term. At the end of the 5-year term, you're going to say, well, let's go out and shop the market for rates. And if you find a cheaper rate somewhere, you want to go get it. So that might be another lender. So your coverage individually is portable. It moves along with you. Whereas if you go to a different lender, you need to requalify, right? You need to requalify. You need to answer those same few basic questions. And if you hit a red flag, you might not get coverage. So that's the risk that you run every 5 or so years. Now, rates. Like I mentioned earlier, what companies do is they strip down a lot of the terms and conditions. So what that means is everyone who's 32, everyone who's 46, everyone who's 51, they're going to be paying the same rate, regardless of health, regardless of pre-existing conditions, regardless of any diseases that they might have. Whereas if you got your own individual coverage, it's based on you specifically. So if you take care of your health, then you're gonna get better rates. If you're a smoker and you're a couch potato, then, well, your rates are probably gonna be a little bit higher. So your rates are going to be based on your health style, your age, your gender. So you have more control having your own individual coverage. Now, utility, I kind of mentioned that earlier, is that what do you want to pay off if something were to happen? You have the freedom and you have the ability yet to control what you pay off. Whereas with lender's coverage, it's just the mortgage and that's it. Now, I made this in capitals because it's very essential. To me, the biggest reason why you would get your own individual coverage is time of underwriting. Why is that so important? Well, that's essentially asking you all the questions, doing all the investigative work initially so that you qualify for the insurance. So then when you do make a claim, no questions asked, they pay out 2 to 3 weeks, you get your money. Whereas if you get lender's insurance, different story. They're going to do their investigation. They're going to start asking questions at time of claim. Now, you might not see the difference in that. Okay, well, when you apply for a mortgage, 10 years ago, they're going to ask you some questions, but then if you make a claim, they're going to start drilling down on the questions to see, okay, well, did this person answer this question right? Is there any discrepancies? If there are discrepancies, maybe there's a chance of the claim being declined. And over the years, we've seen few news articles that insurance company declines a claim because they didn't meet the eligibility. And that's not on the individual side. That's mainly the mortgage insurance. So the banks, the lender coverage, that's what they're being declined on. So I'll give you a very quick example. We had a client a number of years ago. We're starting to have a family. Husband and wife bought a house, got mortgage insurance through the bank. And a number of years later, they had 2 girls in the meantime. A number of years later, the husband passed away. Now, the wife says, okay, well, not a big deal, but they went to make a claim. They went to the bank to make the claim, and the claim says, okay, well, no problem. We'll take a look at the file, and then we'll process everything. And a couple of weeks down the road, she gets a phone call and says, okay, well, unfortunately, there is a discrepancy between what your husband provided versus what the doctor said. So then therefore we have to decline the claim. What was the discrepancy? Well, one of the questions that they asked in the very simplified medical questions was, have you ever had symptoms of depression? He checked off no, because he was never diagnosed with depression. But when the insurance company drilled down into the details, asked for the doctors for the notes, one of the notes said that the client came in today, just did a regular checkup, and he mentioned that he was sad. That was enough for the claim to decline. Now we fast forward, I would say 7-8 years later, the kids are 12 and 14. The wife basically liquidated, took all of her investments out just to make sure that she's making ends meet. Single mom, raising 2 kids, thinking that she had coverage, but it didn't pay out because it just didn't pay out because of the covered conditions, right? So that's what we're kind of working towards and preventing. Now, this is our process. So for a client to work with us, we say, okay, well, let's go through this analysis to find out how much insurance you need, how much insurance you have, so then we can have something that's tailored to you, not just the mortgage, but also to you and your whole financial situation. So we go through this, we complete it, then we find out, okay, well, the types of insurance and how much insurance they need. And what I do is I kind of present the clients some information to say, okay, well, based on the information you provided, here are 3 options to choose from. So we can have a basic one that we just cover the life insurance, whereas we have an intermediate one where we cover life and any serious illnesses. And then the third one, where it's more comprehensive, more things that it covers. So life, disability, and critical illness. So these are 3 options that the client can choose from. Now, depending on their situation, their ability to pay, their health, lifestyle, health situation, they might choose one or the other. but that's up to them. I'm there to provide information to them. Now, here's a quick case study here. This is a couple that I worked with earlier this year, Caitlin and Chris. Recently married, super excited. They were saving money throughout COVID, and they had enough money for a down payment. And even after the down payment, they have a mortgage of $340,000. Their mortgage payments are about $1,700 a month. And they're millennials, very health conscious, great family history. No one has cancer, no Alzheimer's, no nothing. One of the things, throughout the conversation, the wife expressed that she feels concerned and a little worried about the husband's occupation. He's an industrial scaffolder, so he climbs up in high areas, and safety is obviously a huge concern. And the husband was jokingly said that there's some injuries around the workplace, and it's just a matter of time before it's him. So I take that into consideration when I create a plan for the clients. Now, they went to the banks and they said, okay, well, how much is it going to cost us to have mortgage insurance through you guys? They came back to say it's about $235 a month. Now, they're like, well, that seems a little expensive. We still have things that we want to pay for. We still want to go out and travel. So our budget's about $200 a month. So this is the information they provided me, and I provided them just a simple snapshot of, okay, well, what are we looking at here? Like I said, we have the basic, intermediate, and comprehensive options. Now, the basic one is just looking at the life insurance coverage. If something were to happen to you in terms of life or death, that this is what's paid out. Their mortgage, like I said earlier, is $340,000, but you can see here, Caitlin has a little bit more, and also, Chris has a little bit more insurance. Well, why is that? Well, because they need to replace their income. If Chris is the breadwinner, if something were to happen to him, then Caitlin still needs money to survive. They also had a little bit of debt that they also want to cover as well too. So when we tack everything together, we're looking at about, a little over $100 a month. Now, this is a term 25, meaning that the premiums and the coverage stays in force for 25 years, as long as the premiums are paid. And like I mentioned earlier, when you're getting lender's coverage, it's a declining coverage, because as you're paying down your mortgage, then your coverage also decreases, right? So this is a fixed amount. So it creates a lot of certainty. Now, typically I would say, okay, well, in the intermediate level, we'll take a look at life and critical illness. But in this situation, because of the things that they've expressed to me, they're saying that it's important that we cover Chris's income. If something were to happen, if he's not dead and if he's still alive, let's say if he gets sick or if he gets injured on the job, we want to make sure that we're still able to maintain our lifestyle, right? Because that's what essentially we're protecting. We're protecting their lifestyle, we're protecting their home that they save so hard for. So when I created this, okay, well, we still have that term 25 of life insurance. And then with this one here, with disability, if Chris is injured or sick and he can't go back to work as a industrial scaffolder, then the insurance company will pay $4,400 a month after 90 days for 5 years maximum. So when we add everything up, the premiums are within their ballpark, about $210 a month. So it's still reasonable. And then lastly, we take a look at the comprehensive level. Say, okay, well, if we want everything to be covered, everything under the sun to be covered, we're looking at life, disability, and critical illness. What does it look like? Okay, well, we have enough money to cover for your mortgage. We have money to cover for your mortgage payments. And then we also have a little bit of extra if something were to happen, if a serious illness like cancer, heart attack, or stroke were to hit, okay, well, there's $85,000 that gets paid out. Now, when we're looking at the monthly premiums, we're about, $170. So we're well under their budget. So this is something they really looked at it and they considered. The thing is that like being a homeowner is stressful enough already. You have so many things to consider and think about. You have your down payment that you got to save for, you got to worry about the mortgage, and you want to get the best interest rate. Not only that, you need to have money to pay for furnishings, decorating, and upgrading your appliances. So it's one thing after the other. It gets so overwhelming for homeowners. The thing is that realtors, you guys are at the forefront of helping these individuals, providing them with the right and necessary information for them to really protect themselves. Because at the end of the day, like we don't learn about this stuff in school. So it's important for us with information to transfer this information to them so then they can make a very good financial decision, right? So when we're creating these things, okay, well, who are we targeting here? Well, essentially, most people with mortgages. So people that have at least $100,000 in mortgage debt, ideally they're healthy, but I know we don't live in an ideal world, and health, everyone's health circumstances is a little bit different, but that's okay. We can still get rates for them. But they're also wanting certainty that they know their coverage is going to be the same. And not only that, that their premiums are going to remain the same as well too. See, the thing is that that type of certainty is something that you can rely on, right? Because when you're buying mortgage insurance through the lender, it's like online dating. You like what you see when you're going through their online profile, so you ask them for a date, right? But it's not until you meet them in person, then you're like, whoa, what filters did you use to make yourself 10 years younger and 20 pounds lighter? Like, that's something, that's a surprise that you don't want to encounter, right? So that's the same thing with mortgage insurance, is that you get excited about buying your dream home and you don't think twice about the details in the mortgage insurance. It's not until something happens to you that you get this unpleasant surprise. And that's what we're trying to prevent, right? Not only that, like most times when someone's setting up the insurance for you, they're not even licensed. Like, as a realtor, can you imagine buying a home from someone who's not licensed, right? But the thing is, the lenders make it so easy and simple to qualify for this insurance that it's really too good to be true, right? It's not until you make a claim and when you need the money the most, you find out that what's not covered. So I hope from this presentation, you guys would learn and understand the difference between having your own coverage and also the coverage that the lenders provide. So I want to thank everyone, for their time, paying attention. Here's my contact information if you want more information. I'll turn things over back to you, Alex.
All right. So yes, so thank you so much, Jeremy. We're going to leave this slide up here. We do have a couple of questions. Apparently the chat function wasn't working, but I got a couple text messages. So one of the major ones is, how do you determine what's a better situation for someone, term insurance or whole life? And I know this might go down a whole other path, which could probably take up another half hour, but maybe explain just the differences between those two products and then a brief explanation on which one would fit for who.
Yeah, so a quick background is that term insurance is what is temporary, and whole life insurance or universal life insurance is permanent, meaning that it will be there for the rest of your life. And how I kind of get people to visualize what term insurance is that your coverage and your premiums, stay the same for the certain period of time. But after, let's say you get a term 10, at the end of 10 years, your premiums jump up. So every 10 years, your premiums go up like a staircase. And every step you take, it's steeper and steeper. So it gets pretty expensive. But it's good because it covers things temporarily, right? Like your mortgage. You're not going to have a mortgage for the rest of your life. So you'll have something temporary to cover that. And after you're done paying for the mortgage, you don't need it anymore. Or like when your kids are young, you want to cover when they're young, unable to look after themselves, but once they're able to flap their own wings, you don't need that coverage anymore. So there's a combination of both, and I like to have a combination of permanent insurance and term insurance just to kind of make sure everything is well-rounded, because permanent insurance is more so for final expenses, paying for taxes, providing a legacy to your family. So there's different, pros and cons for both of those. That's a very good question. I could definitely go down a rabbit hole.
Yeah, I knew it was a rabbit hole question. Next question. So ideally, the best time to bring up this conversation would be prior to the mortgage funding. However, is there ever a bad time to bring this up?
I don't think there's necessarily a bad time. Like we've had clients who had mortgage insurance through the banks, and after a number of years, they got enlightened or got education or information that they know that they might not necessarily want to rely on that. So they come to us and say, let's change over the insurance. But I think at the end of the day, like it's not so binary, right? There are times where I say you should probably have some insurance. Maybe you can't afford this right now, but have something, right? Some is rather than nothing. So have the lender's coverage. At least that provides a little bit of coverage available to you. But once you're in a better position, then you can look at individual coverage that is a little bit more robust, essentially.
Wonderful. And what areas do you cover for service?
Well, in the second slide there, we do provide.
No, sorry, geographical area. Not your services you provide, but what service area do you work?
BC, Alberta, and Saskatchewan.
Okay, so the Western Prairie provinces and out west. So that is fantastic. So I'm going to end it right here. Thank you again so much, Jeremy. You can see his contact information here on the screen. So if you do have questions, please do reach out to him directly. It was a wealth of information today. And as always, please click like the video and click follow on our channel here so you can get up to date on anything more that we present. So thank you again, Jeremy. Have a great day.
All right. Take care, Alex.